this time about the carry trade, but this time, what is happening in Japan? This is not, people are going to say, well, why do we care about Japan? Like, what do they have to do with us? Well, other than importing a lot of stuff from Japan that we do, um, you guys have to understand the dynamic between the US dollar and the Japanese yen. The Japanese 30-year bond is called JGB, right? Japanese government bonds. The 10-year, 20-year, 30-year, just like we have it here. 40-year now they have it. We haven't started doing 40-year, but you have to understand the relationship between global interest rates to figure all this out. Japanese interest rates were literally negative for 15 years because they had a deflationary cycle. Well, now they're out of that. Now they have an inflationary cycle. They had such loose monetary policy for 20 years that now, and they kept borrowing money. They kept printing and borrowing and printing and borrowing. Well, now they're basically where we are. And their interest rates, especially on the 20 and the 30-year long end of their bond curve, it's just skyrocketing. So you guys are going to say, well, what does that have to do with us? My mortgage is not on Japanese interest rates. Well, hold on a second, because there is a direct correlation of what happened. So when the Japanese interest rates were zero, a lot of U.S. institutions, a lot of hedge funds, by leveraging 20x, 10x, they went and borrowed money at zero. They brought it to the U.S., invested in stocks like NVIDIA's or Mag 7s or U.S. bonds, which were at 5%. So that's called the carry trade, right? We're taking it from there, carrying it over here, and then investing at 5%. Is it risk-free, though? Well, it's risk-free if the currency stays flat, right? Because there is currency risk. We have to convert our US dollars to Japanese yen, and then we have to do the conversion again when we get out of that trade. Well, for years, it went well until last August when it kind of went sideways. A lot of the unwinding of the carry trade happened, but now Japanese interest rates are absolutely skyrocketing. So if I'm a hedge fund and if I went and borrowed money in Japan at zero, came and invested at 5, 6, 7, or into the market at 20%, I'm swimming in cash. I'm doing fine. Plus, I leveraged it. But now, with the Japanese bond rates shooting up, well, it ain't zero now, right? Or even from short term all the way to the 30-year. Their bond rates are going up. Well, so no more carry trade, right? I can't go borrow at 3 there or 3.25 there, which you guys will see in a minute, the charts, and come here and invest at 4.5. It doesn't make sense. There's not enough room for me to avoid a currency situation or whatever not, right? So now let's look at it. It is really something to see, folks. So this is what's happening. This is on the left-hand screenshot. It's kind of faint, but you guys, can zoom in. This is the current 30-year Japanese JGB rate, 3.2%. Look where it was. Look where we are now. We were almost at zero. Now we're at 3.2%, and we're just shooting up. So the collapse of the Japan's bond market has been incredibly telling. In fact, we're beginning to see some similarities in the US as deficit spending accelerates. It almost seems like investors have lost confidence in the Japanese government's ability to pay down debt. Well, because now they're in the pickle that we are. The bonds are coming due. They were at zero. Now, when you have that much debt to GDP ratio, you have to sell more bonds. Well, the new bonds that they're going to sell has to be at 3.2%, right? So the Japanese central bank can do whatever the heck they want. If the bond market is not going to listen to it. Look where we are, 3.2%. Simultaneously, Japan's debt to GDP ratio recently exceeded 260% for the first time in history. Their debt to GDP ratio is roughly double the United States. We're at about 130, and I'm going to look at the second screenshot here. Ironically, the US is currently on a far more unsustainable fiscal path because the dollar amounts are a lot larger here. It's just early still. Well, look at this graph here. The blue one is the debt to GDP ratio, Japanese one. Believe it or not, folks, the gray one, which I've been talking about, saying that US is just a much bigger version of Greece with a printing machine, the gray one is Greece. You guys believe it? And the black one is the United States, and the red one is China. So basically, the whole world is printing. They're inflating, and that's why all these asset classes are going through the roof, like Bitcoin, like gold, like stock markets, right? But believe it or not, look at the Greece's debt to GDP ratio. Actually, it's been coming down last 2 3 years, while the U.S. is about to catch up to Greece. So maybe I am going to be justified when I say U.S. is just a bigger version of Greece with a printing machine. Over the last year, Japan's 30-year bond yield has surged 100 basis points in 1 year. This created massive unrealized losses for financial institutions. Let me explain this to you guys. If rates go up, so each bond comes out at a par value, we call it, our face value of 1,000. Okay, when the coupon on it is 2% and interest rates go up to 3%, that $1,000 becomes $900, $850. So you have unrealized losses. But now you can say, well, Serge, you can hold it to maturity. Yeah, you have to hold it for 20 years, 30 years to get your 1,000 back. Because if you want to liquidate, now you have to liquidate at 850 because the coupon on the bond you own is 2%, but the actual interest rates are 3%. So the underlying asset price fluctuates wildly. Unrealized losses on domestic bonds for four of Japan's largest life insurance, because we're going to get into that in a minute, who's holding the bag here. Four of Japan's largest life insurers quadrupled in 12 months to around record $60 billion in Q1 2025. Now let's take a look, and this is where you guys need to pay attention now. Now let's take a look at Japanese versus US yields. Since 2020, 5 years ago, the 10-year note yield has seen a 500% increase in Japan. This is just below the Japanese, this is in the US, this is just below the Japanese 30-year bond yields move. The green line here is the US rates, the red line is the Japanese rates. The US is flooding the bond market with so much supply to fund deficit spending that bond prices are falling. So when bond prices fall, that means interest rates are going higher. Okay? There is an inverse relationship between interest rates and bond prices. There is pricing on bonds just like stocks. When rates go up, bond prices go down. When rates go down, bond prices go up. And it gets marked to market. So as I said at the start, the difference between the US 30-year and the Japanese 30-year is getting narrower and narrower. How's that happening? Well, the US 30-year is moving higher, while President Trump has cut interest rates by 300 basis points. Like, I don't know what kind of good stuff they're smoking at the White House. But now the Japanese rates have gone to 3.25%. We're right a touch above or below 5% on the 30-year. Their 30 years is catching up to 3.25%. Well, there's no more carry trade. We can't go borrow at 3.25 and come invest here at 5. It's not going to work. And last but not least, the loss of confidence accelerated after this data. The Bank of Japan's unrealized losses from government bonds hit a record of 198 billion in fiscal 2024. These are paper losses. You can hold to maturity and you should hopefully get your $1,000 back at face value. But in 20, 30 years, they have printed so much money that $1,000 you're going to get back is worth probably half. You guys get it now? So paper losses have tripled from the previous year's 66 billion. Yeah, because rates are going up and bond values are going down. Unrealized losses are rising at a record pace. Last but not least, to make things worse, the Bank of Japan owns, ready for this, 52% of all domestic government bonds, just like in the US. The Federal Reserve owns, that's how they flood the market with or try to lower interest rates. They'll go buy mortgage-backed bonds. They go buy treasuries. The Treasury issues the treasuries, but they can go buy treasuries. Figure that out. So in Japan, 52% is owned by the Bank of Japan. By comparison, in Japan, life insurance, other banks, and private banks and pension funds hold 13.5, 9.8, and 8.9 respectively. So in Japan, if you add 52 on all those numbers, about 85% plus of all bonds that are underwater is owned by banks and pension funds. The bonds crashing on fears of government collapse are mainly held by government itself. So the government itself is holding these bonds and they're eating it. And the bond market in Japan, just like in the US, They're not buying whatever the Japanese government is selling. They go, we have a problem, Houston. We're going to increase rates. You can talk all you want about lower rates, Mr. President, with all due respect, and to Mr. Scott Besson. This is not the time to cut rates. We're at all-time high in everything. You cut rates here, asset classes will melt up, inflation will accelerate, and the bond market here is telling Mr. President Trump, not so fast, not so fast.